Hi, I'm Jordan Bennett with Jordan Bennett and Associates at Keller Williams Realty, and today I want to talk about a subject that I'm very passionate about, and it's investing in real estate. And does it make sense to invest in real estate? Should I invest in real estate? This is a question that a lot of people ask. Now, there's a lot of benefits to investing in real estate, including tax benefits, the power of leverage. There's the fact that when you're investing in a home, you're investing in a real tangible, hard asset. You're investing in sticks and drywall and sheetrock and brick and whatever that home is made out of. And you're investing in something that is shelter and that can house somebody and essentially produce a rental income. Versus when you're investing in a stock certificate, stocks have gone to zero. Companies have gone bankrupt. It's rare, with very few exceptions across the country, where a home has gone to zero because it is still that hard asset and it's something that is rentable. So there's a lot of different directions we could go when talking about real estate. I want to talk about three that I think are the most significant as far as why investing in real estate makes sense. And those three things are appreciation, debt pay down, and cash flow growth. Now, probably the most intuitive and what a lot of people think of when it comes to investing in real estate is appreciation. I'm going to buy this home, and in the next 30 years, 20 years, 10 years, it's going to double, triple, 10x its value, and I'm going to get rich quick. Real estate should not be viewed as a get rich quick vehicle. It should be viewed as a get rich slow vehicle, because guaranteed, it is. If you have a long-term approach to real estate, you will make money in the long term. Now, appreciation is probably the most intuitive thing you think about when investing in real estate. You're going to invest in the property, it's going to go up in value, you're going to sell it for more than you bought it for. That is speculative to some extent in the short term. It's more guaranteed over the long term. The second thing that I think is more significant and should be focused on more than the appreciation is the debt pay down. Debt pay down is essentially every time you make a mortgage payment, a portion of that payment is interest and a portion of that payment is principal. What that means is you're paying down your debt over time so that at some future point you don't owe anything on that home and you own that home outright. So an example would be if you were to buy a $100,000 home, not going to happen here in Southern California, but let's say you were to buy a $100,000 piece of property and you put down a $20,000 down payment and you're taking out an $80,000 loan. So today on day one, when you take out that mortgage, you owe $80,000 on that property. Now, if you hold on to that property, you don't pull cash out, you don't pull any funny business, but you actually hold that property and you pay it down over, let's say, a 30-year mortgage, at the end of that 30 years, you owe zero. So you now have taken your $20,000 investment and it's turned into a $100,000 investment. Your rate of return, if you want to calculate it over that 30-year period, is about 5.5%. If you pay it off over 20 years, you are earning a little over an 8% return. Now, that's factoring in no appreciation. That's factoring in looking at it as if it's an asset that you bought 30 years ago and today it's worth the same you paid for it. You've still earned between a 5 and an 8 or 9% return. Where can you get that kind of return guaranteed? Now, if you factor in appreciation, that's a whole other animal. This is where you start to see the double and even triple digit returns in some cases. The third thing is that cash flow growth. So what does that mean? It means that over time, rents tend to trend up. So your rent today might just barely be covering your principal, your interest, your taxes, your insurance, and we call it what's called a break even, where your total rent cancels out everything you pay on the property each month. However, what happens across the country, and here in Orange County specifically, rents go up each year. So what that means is that over time, you've got another element factoring into that total rate of return, which is your cash flow. Every month, not every month, but every year, as you renew those leases, hopefully those rents are going up and you're having that built-in return as well. So when you look at appreciation, debt pay down, and cash flow growth over a long period of time, investing in real estate makes a tremendous amount of sense. It's something that I'm passionate about and would love to speak with you in more detail if you have any questions. Thanks so much for watching.